Most people think of investing as stock tickers, yelling, day trading, pyramid schemes, quaaludes, and possibly even wolves of some sort. But contrary to popular belief, investing does not have to be difficult, stressful, or involve copious amounts of narcotics. Before we go any further, please like the video and subscribe to Financial Freedom and ding that thing right there to help push you further in your personal finance journey. Today, we're going to get to the nitty-gritty of investing, covering everything from where to put your money and the do's and don'ts. We'll go into great detail shortly. My 20s were a rough time for me financially. I was a dollar menu eating, mega penny pinching, broke type guy with little resources. If you find yourself in a similar position, it may seem hard to even consider investmenting. That is because you are simply not in a position to do so as of yet. Most financial specialists believe that you need to perform two significant actions before opening your first investment account. 1. Put together an emergency fund. 1 month's worth is plenty to get you started, about $1,000. 2. As soon as you do this, you should get rid of your debt, starting with the highest interest debt first. Start with credit cards, school loans, vehicle loans, anything with rates of 8%, 9%, or 10%. Just these two actions are huge steps to improve your finances. And if you're like me and graduated with $100,000 in student loans, it'll take you years of saving, patience, frustration, and sacrifice to get there, but stay vigilant. Now, when you've paid off all your debt, you can start putting money into the stock market. When asked about how he became wealthy, Warren Buffett famously responded, "Living in America, some lucky genes, and compound interest." The power of compound interest is why you should start investing ASAP. The market has historically returned somewhere between 7% and 8% annually over the course of a long time horizon, 40, 50, or 60 years. Let's say you start investing at the age of 25 and keep putting away $5,000 annually until you retire at 65. Nearly $1.3 million will be yours after 30 years at an annual return of 8%. You'd have $200,000 if you decided to just put that under your mattress. What a difference, one that can drastically alter your life. Okay, let's say we're ready to start. Where do I go to create an account? Which service should I employ? What is the recommended sum? Really, it's kinda a lot. If you've considered investing previously but never actually done it, I'd wager that this is where you get stuck. So let's break down the steps you should take. If your U.S. workplace offers a 401k plan with matching contributions, you should begin investing there before you pay off your debt. Put in as much as you can into this 401k plan because your employer will match a certain percentage. Next, a Roth IRA is the first type of account you should establish. They are highly recommended by financial experts due to the many tax benefits they offer. But which businesses are worthy of your hard-earned cash? When it comes to my own investments, I trust Vanguard. I have no ties to them. I love them because they are inexpensive and they won't try to trap you with hidden costs. Schwab, Wealthfront, and Betterment are excellent as well. You should note that the additional cost of using Wealthfront or Betterment might be as much as 0.3%. You could certainly do worse. Since I rarely access Vanguard, the inferior user interface that it has doesn't bother me. And they place a premium on charging reasonable rates. If you haven't already made an account, it's easiest to just choose Vanguard. They have low costs, provide a wide variety of investment opportunities, and are simple to set up. So, you signed up, what's next? Time to make investments, and despite what that weird-smelling dude at your job may have said, putting all your money in Bitcoin is a bad idea. The smelly dude may say, "Why would you invest in the stock market? You only get a 7% return. With Bitcoin, you might expect annual returns of 50% to 60%. To that I say, let's do some simple mathematics that you obviously failed to learn in school, smelly. If your investment yields an average of 60% every year, you would soon have more money than there is in the entire universe, and there aren't any investments that can deliver returns of that magnitude on a constant basis. And if you don't want to shower, smelly, at least read. When people make highly risky bets, they are often acknowledging that they have lost the money game for themselves and that the only chance they see of winning is to buy a lottery ticket and Hail Mary. Moreover, that's not a sound investment strategy. It's generally a bad idea to put all of your investment funds into one investment vehicle. You should diversify your portfolio by purchasing shares of an index fund rather than putting all of your money into a single company, stock, or wager. So, not only do you smell, but you're gullible as hell. Index funds are a great investment vehicle. They are a sort of mutual fund that pulls together many asset classes such as stocks, bonds, and other investments into a single pool, granting you the diversity that most financial experts elegantly speak of. Though all investments involve some degree of risk, diversifying your investments in something like an index fund mitigates some risk. Let's talk retirement. For our golden years, we need to know what assets are secure over the long term while still providing a sufficient return to meet our basic needs. A good option for this is a target date retirement fund. With these investments, you pick the day you plan on retiring, put your investment funds into the account, and it does all of the investing for you. This type of account diversifies itself automatically. It incorporates both stocks and bonds, including both local and large cap stocks. They have very little pricing structure. Also, there is no financial advisor. Stick a pin in that because we will discuss more about financial advisors shortly. All of this investing is done by a computer. It is so easy and effective that people can hardly believe it. Their line of questioning goes something like, "So you're telling me that I just pick one target date fund, I invest in the same fund in my 401k, my Roth IRA, and that's all I need?" My answer is simply yes. The vast majority of investors will benefit greatly from a target date fund. Patience. One of the most challenging aspects of investing in the stock market is the time spent waiting. Growth isn't linear. Therefore, learning to control your emotions and risk tolerance is crucial if you want to amass riches over time. Most people can't handle the unpredictable nature of the market, and things have been looking a little precarious during the previous 12 months. The economy seems like it might be entering a downturn. The threat of a recession is still a major concern. According to a survey conducted by the Wall Street Journal, 61% of economists predict a recession will occur within the next 12 months. Market fear increased as a result. What would I tell someone who is witnessing everything unfold before their eyes and is tempted to cash out their 401k? Don't do it. Attempting a withdrawal is one of the worst moves you can make with your money. Let me elaborate. Attempting to take money out of the market and put it back at the correct time is known as timing the market. There are a number of issues with this. Firstly, you have no idea what the market will do. Your smelly coworker may claim to understand the market, but as previously discussed, he's not as smart as he seems. It's not that simple. We see on all types of financial news broadcasts that people who attempt to interpret where the market will go are often more wrong than right. The market behaves in the way that it behaves. It's impossible to foretell. Also, you need to be right twice. Once when you take your money out, and again when you put it back in. You kind of have to do the impossible twice, so I don't recommend this. The solution is to consistently invest in a small amount each month. It doesn't matter if it's up or down since you have no idea how it factors into the big picture. You can invest as little as $100 or as much as $5,000 per month automatically in your Vanguard, Fidelity, or Schwab account. It simply keeps coming in. When prices are high, investors tend to acquire fewer shares. For the same amount of money, you can purchase more shares while the price is lower. Dollar cost averaging is a strategy that often outperforms market timing by a large margin over the long term. After initially investing, the finest move I ever made was to not stress over my assets and instead to let them operate in the background. You should observe things, but not daily, maybe once every 6 months. Keep your mind off of it and let it do its thing. Keep investing, and your wealth will expand tremendously. Now, let's get back to the financial advisors who do so-called fund management. A certain percentage of you will have parents or friends who invest and use financial advisors. Ask them to ask Bob, that finance wizard who claims to care about their future, how much they are paying him. When asked, Bob will probably go into some fluffy lecture about how his job is to defend your money. You see, I care about your well-being and I am vigilant in monitoring the situation and making the appropriate blah blah blah. Honestly, you gotta tell your people to toss Bob into the bushes. Get rid of him. The average financial advisor charges 1%. You may be thinking, 1%? So what? That's nothing, and having another set of eyes on my investment can't be a bad idea. But if you pay a 1% charge to your financial advisor, they will keep 28% of your gains over the duration of your lifetime. Some of these con artists charge a 2% fee, which means that more than half of your profits will go to them. Sheesh. It might be hundreds of thousands of dollars if you're just getting started in your 20s and have a modest income. Steer clear of these folks. They are not needed in a modern world of investing. If you really need a financial advisor because things have gotten difficult, you have stepchildren, or have another situation that necessitates having one pay an hourly charge or a project fee, but never a percentage of assets under management. Okay, so the majority of the information we heard today was rather straightforward. The world of personal finance and investing is highly nuanced, so it's important to do your homework to ensure that you're making the greatest decisions for you and your loved ones. So, I've included some links to those investment companies we discussed in the description. Check it out. Thank you for watching, and if you're interested in watching more helpful financial tips, check out the other videos here and subscribe to Financial Freedom.